Thanks for tuning into this video. Discussing the comparison of the performance of various funds under the NPS across the available asset classes. This comparison is as of the August 2025 month. Now, for those of you who are not aware, what NPS is a government-backed scheme for retirements in India. It invests in diverse classes such as equities, corporate bonds, government securities, and alternate investment funds. This is designed for long-term wealth creation because it's a two-way for retirement purposes. Investors have a provision to change the allocation percentage to these funds between these funds, and those are limited to certain cases, with each fund having a certain threshold. Please refer to the NPS website for further details on these on the exact percentage allocations, or else there are other reliable videos available on the YouTube as well that provide a comprehensive view of NPS as well as the tax benefits that it provides. Now, why this video? Um, though the NPS website provides information on the fund performance, um, it does it at a point in time basis. So it provides the fund performance as of today if say invested in that fund say some X years ago. Now this I present the comparison using rolling returns as it provides better insight into the consistent performance of funds, relying on and not just relying only on one-time winners. Um, this is particularly important for a retirement portfolio because consistency is the key. Consistent performance, funds with consistent performance are more likely to provide the same in the future. Uh, now, to achieve a common scale for comparison of fund performance, I use the below matrices. The first is average CAGR. It captures the growth potential. I've given it a higher rate of 40%. The higher the average CAGR, the better is the fund performance. I've also used few risk-related matrices to compare the fund performance. One of them is the Sortino ratio. This is similar to Sharpe ratio, but this only captures the downside returns, deviation of the downside returns. I've given it a weight of 10%, and higher the Sortino, the better is the fund performance. The next risk-related metric is the maximum drawdown. It captures the maximum fall in the portfolio value. The lesser the maximum drawdown, the better is the fund performance. I've given it a weight of 10%. The next metrics I considered is the Kalmar ratio, which indicates the recovery from maximum drawdown. It is determined as the ratio of the average CAGR by the maximum drawdown. And I've given it a weight of 10%. Higher the ratio, the better is the fund. Uh, I've used two two matrices to capture the tail risk. One is VAR and the other is conditional VAR, both at a 95% confidence. The VAR captures the expected maximum loss, uh, and CVAR captures the average loss when VAR threshold exceeds. Uh, Both have the inverse relationship to the fund performance, with lower values indicating better fund performance. Allocated 5 percentage weights to these each. And the last metric that I used to compare is the horizon vintage. This indicates the survival of the fund or the age of the fund indirectly. Um, and the higher the vintage, uh, uh, the better is the fund performance. And I've allocated a weight of 5% for this. The weighting ensures both it captures both the growth and the downside protection, um, in order to be aligned with the objectives of the retirement fund. This is not an investment recommendation. Please do your due diligence while investing. No. This is how the equity tier 1 fund performance looks like, considering a 5-year rolling window. Um, Of the available AMCs, only seven AMCs have comparable data for a 5-year window. Of this, ABSL is ranked one, followed by HDFC, and then followed by ICICI Prudential. Yeah, ABSL is relatively new among these three, hence any of the second, third, and fourth rank funds can be chosen because they offer similar performance, with HDFC slightly performing better than the rest. Now, a detailed list of funds of the equity tier one funds is presented here. And pause and look for uh, the same. Moving on to the corporate tier one fund performance, again across a 5-year rolling window. The top three funds are HDFC, ICICI Prudential, and SBI. They have comparable returns, but if you look at the metrics across the seven AMCs, pairing ABSL for its shorter vintage, they have similar performance values, but with slightly uh, higher ones observed in the top three funds. You can pause and refer to the detailed fund performance across various uh, rolling horizons. Coming to the performance of the government bonds tier one funds, LIC is ranked one, followed by HDFC, and then Kotak, and followed by ICICI Prudential. Any of the top four funds have similar matrices, with LIC slightly performing above the rest. You can pause and check for the detailed fund performance for government bonds here. The alternate investments category, which is relatively new compared to the other three. The fund performance is as follows. SBI is the top ranked fund, followed immediately by HDFC, and LIC is the third fund in this space. So if you observe the results across the various categories, HDFC has been the consistently in the top three. That's another interesting observation. Now, for a detailed list of the alternate investment fund performance, please refer to this. I look forward for your comments and feedback, and basis that I plan to do this maybe every quarterly so that it can help your fund evaluation. Thank you so much for tuning in.